Presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, folks, we're having our regular commodity show today for TFNN. If you have any questions, it's 877-927-6648, and I'm going to spend some time with silver today and also some gold because these markets are, really getting overbought here, but on a long term, they're starting to look really good because we're getting a little bit of open interest and volume interest coming into the markets, which is a really good sign. And this next sell-off, if we do get one, and we will, we're going to find out, where the support's going to come in. We really want to try to get in on that. The DBA that we looked at several weeks ago is still doing okay. And, of course, we're going to look at soybeans, and we're going to be looking at corn, which has had another really good move. But what I'd like to start off with today is just a little bit of some trading tips that might help you folks, because I know a lot of folks that are in the Tiger Tiger Network family, do a lot of day trading and things, and there's always a lot of discussion about trend and how to take profits and things like that. And all I'm going to do is talk a little bit today about the AB equals CD pattern, which is the lightning bolt pattern, that was discovered by Gartley, way back in 1937, and talk a little bit about that. So if you get a chance today to go into the Tiger TV, you'll see that I've posted a chart of the E-mini 5-minute, and it's basically going over yesterday and today, and all I did was take the real easy AB equals CD patterns to see. These are the ones that formed over several hours, and it'll show you that these patterns work pretty well most of the time. Remember, it's only probabilities, and there's 3 of them that are listed on the chart that you'll see in Tiger TV. And remember, you can trade these, and the thing to keep in mind is if you're going to trade a 5-minute chart, just look at the 5-minute chart. Don't worry about the daily or the weekly or the 60-minute. If you're going to trade a 5-minute chart, that's basically what you're doing, is you're trading a 5-minute chart. And you don't need to know any more than that, because you're not going to be in this thing for 3 days. You're going to be in it for maybe an hour or 2, which is 12 to 24 bars. And that's what the whole secret, if you're doing intraday trading, is that you want to focus on that time frame that you're looking at. Now, if you're looking at a position trade and you're going from a daily to a 60-minute to a 15-minute to a 5-minute to massage what your entry point is going to be, then that's what the real key is to stay with that time frame that you're looking at. If you're looking at a daily chart, that's a total different chart than a 5-minute chart. They have no relationship at all. And that's what people do, is they'll put a trade on to the 5-minute, and then they'll go to the hourly chart, to see, what's happening over there, and they're 2 different charts. They're different vibrations, and that's really what it's all about. So if you'll keep an eye on this chart, if you get a chance to go into Tiger TV and look at that 5-minute S&P, you could do one on the euro, you could do one on crude oil. It wouldn't make any difference. They all look alike, and it's just the fact, if you're going to focus on a shorter time frame, trade only that shorter time frame. And they are feasible to trade because we have great volatility. You basically have the same ability to trade like a floor trader now, because of electronic trading. Commissions are very small. The stops are, recognized very easily as far as being filled correctly, and that's the main thing of what you really want to be looking at. Now, yesterday's show we talked about the importance of that 1323.50 level in the S&P. We went a few points above that. We did not take the highs out in the Dow Jones. We did not take the highs out in the New York Stock Exchange Index, which was rather surprising to me. And so whether we turned down from here or not, but all I know is that that weekly high that we made on the 26th, several days after the big astro date that we were looking at on the 23rd, which was also the new moon, and then we had the Bradley model come in on the 30th. So we were within a day or two of this, and if the market does close down here and starts down, then we'll have a pretty good idea that we're going to get ready to go lower. But believe me, that's still way out of the woods on the basic stock market. Now, I know we're going to talk about the bonds, later today because, with the stocks coming down, the bonds have held up incredibly well. They only backed off a point or so, from the highs. We went from about 145 down to the 144 level, and, we're coming back now. So that bond trade is still starting to look like it's going to be okay. But I do want to talk a little bit about silver right now because silver is the poor man's gold, and it is actually doing something today that I was not expecting it to do because it had held the 786 level for quite a while, and now we've gone above that level. We're now trading above the 83.60 level by 40 cents. The problem is we've been up since December the 29th, so we've been up basically 6 weeks without a correction. So we will be getting a correction somewhere in here. And as all of you know, I do not buy strength, and so I missed this whole move up on silver. We saw the double bottom coming in, but as far as giving a recommendation on the show, I never really did that because I don't like to buy strength because it increases the risk. And in this particular case, it was the wrong thing to do, but that's trading. But we will get a sell-off here rather shortly, at least I think so, because we're up 6 weeks, and that makes it an outlier event. And so we have to watch that very close. And the thing that we want to keep an eye on is also the SLV, which is the ETF for the silver, because we were looking at that when silver was making that double bottom from many weeks ago. We were making that little butterfly pattern at that point. And if you have a chance to go into Tiger TV, you'll see that when we were down around that 26 level, we were making a much lower low in the SLV than we were in the September futures or in the March futures at that time, because what was happening is we were taking out the low in the SLV by a 1.27 expansion, but with the futures we were only making a double bottom. We talked about that quite a bit. So now what's happening is we've had this really strong rally. Now if we do get a pullback here, and the ideal thing would be to get a pullback to the 618, and we'll wait for that to see if it occurs. But these markets are turning, both gold and silver. Well, I've been saying that for a while. They just haven't given us a chance to buy it. But they're turning to the upside, and they're starting to see open interest and volume increase. And if you remember, when they topped back on April the 25th, the exact opposite was happening. People were leaving the market like rats, leaving a sinking ship. So this is a different situation. And remember, we had a nice correction. We had a 30-some percent correction in both gold and the silver. So if that's all we get, we could be looking at considerably higher highs in these things if in fact it does. But we will get a chance, I believe, to get in it because the markets don't run forever, and we're up about 6 weeks. We're actually equaling what happened between September the 26th and November the 7th, and then we had a big correction, and we're completing that type of a move right now. So this is what we want to be watching for in the silver market. If you're watching the SLV, what we want to be watching is the fact that we are getting, if we could pull this thing down to about $5 in the SLV down to about 28, that would be a really good place, to take a look at silver from the long side. And so we have to keep that in mind, for a major thing to look at. Now we have something really significant happening in the crude oil market that we talked about. Yesterday on the show, I said there was a really strong possibility that we were going to break below that 96 level, and we have certainly done that. And we have broken below the 96 level, which is the 618. level, and it looks to me like we are getting ready to head down into the the low, or well, not the low 90s, but the high 80s, around 88 to 85 is what this could be. Now, the reason why we think that in the crude oil is because that we tested that 707 level at $103 per barrel, 3 different times, and we could not get through it. And so that tells us that there's so much resistance there that just like a magnet, that's pulling the market down. We're going to be at a little bit of support at the 94 level, which, the market's coming down so fast that it looks like it's going to go through there very easily. So we've gone through 96. That sets up 94 as the next level. But, really with the market coming down every day, it really it could go much, much lower. So we want to be watching. Once we're already below the major point, which was $96 a barrel. So that's what we're looking at. So we've got our first caller calling in from Tampa, Florida. Don, are you there?
Yes. Hey, Larry. We really enjoy your show. Just had a couple of questions because I'm kind of new at working with the Gartley, and I appreciate your help in bringing me up to speed on this. But when it starts working, how do you project where things might go? Is it based on the Fibonacci?
Yes. You have to ask yourself, Don, these questions. Once the market repeats itself, it will repeat itself over and over again. It might not do it exactly the same way, but it will do it within the same ratios of the Fibonacci, ratios of expansion. And if you're looking at the, like the ABCD leg, what will happen is that after the ABCD leg is formed, what you would be looking for, let's just take the cash S&P, the SPY, and we've gone a little bit above the high. We were looking for it to come in at around 130. 132. It's got up as high as 133. So the first correction that we would be watching for would be the 382 retracement of that last move, which would take you into the 128.25 level. You see, that's what you'd be looking for. Because in other words, as soon as the BC leg has formed, it eventually goes to the CD, and then you take 38% of the CD leg. Let's say the CD leg is 100.
Right.
And if you took 38% of that, which would be 38, you subtract that from 100, that would tell you that the market would come down to about 62.
Right.
And that's where your first profit objective would be. And if it gets to 62 really quickly, it's telling you that I'm going to give you a lot more. And so you just wait and see, what the next move is going to be. This is, in fact, what's happening with crude oil now. It's giving you too much money too fast, which means it's going to give you a lot more on the short side.
Interesting.
Don, stay with me one more time. There's another little trick with the Gartley that I think you might know and you might like to hear about. So stay with me, please.
I will. Thanks.
877-927-6648.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You've always taken the long view when it comes to investing. But what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while actually reducing your overall risk? At At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns, making missed opportunities a thing of the past. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, Don, are you still there?
Yes, Larry. I had two more questions.
Okay, let me give you one little bit of advice about the Gartley. Okay, the secret to the Gartley pattern is in the BC swing. If the swing on the BC leg comes out very, very strong, explodes out of there, that tells you that the market is most probably going to exceed the CD leg by just a little bit, maybe even 1.27 or 1.618. So watch that C point, because if it comes out really fast, that's what you're looking for. What are your other 2 questions?
Okay, real quickly. Do you take a full position in the beginning, or are you scaling in or scaling out?
We always take a full position going in. We usually risk about 1/4% of the amount of money that we trade, and then what we do is, as we start to make profit, we will scale out of the trade. We never add to losing positions. That's the worst thing you could do in all of trading, because that's telling the market that you know more than it does, and you're willing to take more risk even if you're wrong. So you want to put either your position on the way you think it is, but don't. You can add to winners, but don't add to losers. Adding to losers is the worst thing you can do. That's even worse than not even using a stop, because when you add to a loser, what's happening, Don, is you're increasing your risk, which is against every principle of speculation, and you're also telling the market that I know more than you do, and nobody knows that.
I would agree with you there.
So, yeah, you go in with your position for better or worse, and then scale out of it from there. Think about how much money you can lose, not how much money you can make, and you'll be far better off.
I understand. And what about determining whether to hold for a bigger break? Is it speed or volume that you're calculating or measuring?
What I'm measuring is after the point that I have entered the market, I'm anxious to see how quickly it works. Usually with pattern recognition, the things work right away, because if they don't, you're going to get stopped out and you move on to the next trade. So whenever I'm looking at point D or point C in the trade, I want to see how quickly it comes out of there. Now, what I'm going to do is I'm going to post into the Tiger TV, if you get a chance today to look at it, the chart of Amazon, because we talked about Amazon yesterday, making the big AB equals CD, back on December 29th, and then yesterday we came down to exactly the 786 retracement, and we closed really strong. And, I was mentioning if you bought it, it was around 76 when we were on the air, and I said if you bought it, your stop would go below the 72 level, which was the low of yesterday, so your risk there is about $3. Well, it's up a couple of dollars from that point, but you can see this is how we're protecting ourselves as risk. We know that we don't know where Amazon's going, but that's the good part. Nobody else does either. So all we're going to say is we only have to risk $3 trading $180 stock from here. That's really cheap. I mean, so we're worried about how much to lose, not how much to win.
I understand. Thank you.
You bet. And I hope you do well. If you have any questions, drop me an email.
Oh, I appreciate it, Larry. Thank you.
Okay. Thanks for calling in, Don. Okay, I'll try to repeat that again. Remember, winners think how much money I can lose. They're always concerned about how much money they're going to lose. That's from Bernard Baruch. Don't be concerned on the return on your money. Be concerned on the return of your money. It doesn't make any difference what size chart you're trading, daily, weekly, monthly, whatever it is. Be concerned on the amount of money that you have at risk, and you'll be far, far better off then you focus on, how much money you're going to win. This is how Las Vegas, makes all of their money, is because they have all these flashing signs saying, you can hit 4 sevens and win $10 million, and you can hit 20 tickets or 20 spots on a Keno ticket and stuff like that. And that's all based on how much money you think you can make, not how much money you think you can lose. You got to focus on how much money you can lose. Nowhere on a slot machine will you ever see a sign that says you have no chance of ever beating me, and you will never see anything on the slot machine that says I've taken in $1.5 million more than I've given out. Those figures are not available to us. All we know is that if we put $20 in and lose it, that's our loss. We had some entertainment and we move on. So just remember that, folks. That's the most important thing. Now, since we were talking about the Amazon, I wanted to show you, and this is our commodity show, I wanted to show you the chart that we've been watching, for several weeks now, when gold was making, corn. We're in corn now, which is our largest crop in the United States. It shows the last year in corn, and when we get back from our commercial here to pay a few bills, we will discuss the corn market and where we think it's going. And 877-927-6648.
Hi folks, this is Tom O'Brien. If you want to get great trade setups in equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com, under newsletter, hit the Market Insight tab for your 2-week free test drive right here, right now.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes a carefully selected portfolio can lower your volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angelo O'Brien, financial advisor and certified financial planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and someone asked a question about Bernard Baruch. He was one of the most famous speculators of the 20s and 30s. He was on the same plane as J.P. Morgan, but at a much he wasn't a public figure as J.P. Morgan was, but he was a very, very important person during that period. One of the most famous, if you'd like to read his book, it's called My Own Story. It's his autobiography, and one of my favorite stories in the book was he was talking to Carol Lombard, who was the Marilyn Monroe of that era, and she came into his office and she said, "Mr. Baruch," she says, "what is the secret to making money in the stock market?" And he said, "Young lady," he said, "you have to buy low and sell high." And she said, "Wow," that sounds pretty easy. And she says, "How do I learn that?" And he says, "Do you have about 35 years of free time?" And anyway, he was trying to tell her that it does take a long time. It doesn't, it doesn't take quite that long, but it does take a little bit of time. Hardly ever does anybody ever get it in less than a year, but that's the way it goes. Since we're on the commodity part of this, I happen to be not as much as before, but years ago, back in the 70s and 80s, I did a lot of consulting for many of the Merck firms, and I had access to their records about which customers made money and which customers did not make money. And frankly, most people that start trading, about 95% of those people will lose. But of that group that stays with it, if they stay with it more than 3 or 4 years, they will learn enough of the rules to be profitable. And that's the whole key, is you've got to learn this. It's equivalent of a college education. And frankly, it's probably cost more than a college education, but it does take time, to learn to do this. If it were easy to get into the trading environment, the line would be around the world, several different times. Unfortunately, it's the easiest business in the world to get into because all you have to do is write a check and prove to them it's non-laundered money, and you can start trading. That's the bottom line. Entry and exit into our business is very easy, but to stay there, the longevity, you have to have some knowledge of why markets work the way they do. Okay, let's get back to the corn market because I think that's the thing that we want to be watching for two reasons. The first reason is that we had the big AB equals CD low that occurred in October with all the rest of the markets when there was a lot of hedge fund liquidation and everything. Then we made a double bottom in December, and then we had the pretty strong run up, and then over the last several weeks we had a drop down to the exact 786 retracement. And what's important about this retracement is that if you'll compare this chart, which is corn, to the chart of Amazon, which has nothing to do with corn, you'll see that both of these charts are so similar that it's truly amazing. I mean, if you just go back and look at all of the patterns that are in Amazon and all the patterns that are in corn, you'll see that they're the same. And this is what I preach all the time, is all these charts look alike. If you could take away the X and the Y axis and the title of what it was you were trading, no one could tell you what chart that was. And this goes back to the work that that Benoit Mandelbrot taught, is that all of these things are related to triangles. And everything we're doing with these charts are triangles. In other words, from the low to the high to the next low is usually going to be 618 or 786, just a probability, not a certainty. But this is what we try to do, and this is what's happened in corn. And we've had a really strong rally of almost $1 a bushel, which is $5,000. And corn is now ready to, I think, back off just a little bit from this level, and then we'll see if we can, buy it. Maybe next week when we do our commodity show, we'll be able to, get a low-risk buy on corn. And so this is one of the reasons why you want to keep an eye on these patterns, is the fact that they repeat over and over again. It doesn't make any difference whether it's corn or soybeans or wheat or any of these things, because this is why they work the way that they work. And since we were just discussing the soybean market, we want to talk about that because we focused on this many weeks ago, at least 3 weeks ago, when the soybeans were making the exact 61% retracement of the low that we made back in 2009, which goes back several years. So this price that we came in at $11.10 a bushel is incredibly important. Then we had a very strong rally that took us up to the exact 786 at just under $12.50 a bushel. Then we backed off again to the exact 61%. In fact, what I'm going to do is I'm going to put into the I'm going to try it. Well, maybe I'm not going to do that because I can't get the data to refresh quickly. I'll try to do it as I talk. But anyway, soybeans are ready to top in this area just on a short-term basis because of where we are with the the 786 of the last high. But we'll cover that when we get a correction, and we should come down into the $12 per bushel level one more time. But the one market after, of course, corn is our biggest market. I've already mentioned that. The open interest in corn and beans, all of those are starting to increase. So there's more and more people, coming into the market looking at that. And so, that's a very, very important thing to be looking at. And so we have to keep an eye on that. But I only got a little bit of time left in the show. I want to cover wheat, and then I want to get to the bonds, because the bonds is where I really think at least is my opinion, and of course opinions are like armpits. Everybody has one, and it usually smells. So at least we'll be putting a stop in on this, and we'll be able to watch it. But we want to take a look at the wheat market if you get a chance. To look at the Tiger TV, because we had some beautiful patterns that formed in wheat that we've been talking about, for quite some time, and the wheat held that $6 per bushel level, and has rallied, over 60 cents, a bushel, and that's quite a bit. So that is also oversold, but we'll have to wait and see, if that is going to happen. And that's the main thing. Now I have to, move over to the bonds here because I get more emails on the bonds than I do get anything else. And this is the thing that we're watching. We're only down one point from our highs. We made a high up around 45 and change, and we're almost, getting back to the 45 level again. And this is with the stock market really rallying. And so this is telling us that we have a very strong probability of making this 148 to 149 level. And that's what we're waiting to see. We have to have patience to see if this is going to come to fruition, but this is it. Now, the only thing that concerns me, and I've said this several times, is that when we have a trend, as long as this one has been, and I'm going back 30 years, I posted that 30-year chart so many times in the Tiger TV room that you should be able to find it on any of the archives, that this 30-year channel, that the interest rates have been going down for 30 years, it could have one spectacular blow-off. This could take bonds to a level that I don't even think they have a chance of getting to, which would be above the 155 level. That would put long-term 30-year rates at about 2.3%. Which I can't imagine anybody loaning money for 30 years at 3%, let alone 2.8%. So we are getting close, folks. All we need is a little bit of back off in stocks from here, and we'll easily make these targets in the bonds, and then also our TBT will be getting down to the level that we've been waiting for, for so long. Now, the other question that I get, and it's difficult for me to give a real explanation other than in my own trading style, and people have said to me, look, if you really think that Treasury bonds are going to get to this level, why don't you buy them when they hit these retracement levels? And I don't try to give recommendations because I don't want to take the responsibility for trades, because every time I tell somebody to do something, they don't put a stop in, and if I tell them to take a profit at something, they won't take the profit there. So when the trade doesn't work, I get an email saying, I'm going to put gas or sugar in your gas tank, and I don't need that in my life. So I'm trying to give you some ideas of where these support comes in. The fact that I don't give a recommendation at that point just means that I just don't want to take the responsibility for you losing. I'll do it for myself, but I don't want to take the responsibility for you to do that. That's your responsibility. That's what trading is all about. Hey, I'm not getting paid for that, so I'm not going to do it for free anyway. So that's basically why I don't do that. I'm just trying to give you some ideas of where things are going, and that's what I'm looking at. You've got to make your own bed. You got to sleep in it. You're the one that has to make it when you get up in the morning if you do those things. And so this is what we're looking at. And I think that if you be patient, we're going to be able to get that TBT up into that level, where we want it to go. Now, we've also been really very close. We've made new highs this week in the short-term rates, which are our notes, and we're only a few ticks away from making another new yield low. This would be below 1.8% in the 10-year notes, and they are getting very, very close to that same figure that we're looking at as far as interest rates. We're about a point away in the notes, but a point in notes is quite a bit as opposed to the bonds. The bonds are by far the biggest of the interest rates, trading vehicles, because they trade hundreds of thousands of these every day, and as opposed to the notes trade a little bit less. Shorter term rates, are already below 1%. So it's really, the rates are going lower and lower. It's just a question of when does the people wake up, and if I am correct, and these things are going to go. Now, realize that people like Bill Gross and George Soros and a few other people think that, Treasury bonds are going to go up and stay at these low rates for 2014, just like Mr. Bernanke said a few days ago. But I, as I mentioned, and I showed yesterday on the charts, going back to 1790, there's never been a period where the rates have stayed at those levels for several years. It just hasn't happened. That's 222 years, folks. that's like the Gartley 222. I mean, this is a very, very unusual event. I mean, so we have to take a look at it. This is probably the most time I've ever spent on a trade of the year, but I've gotten more responses from that stuff, than anything else, that I've looked at. And that's the main thing that we're trying to keep a look at. Now, I have to cover the gold market because gold, like silver, I believe is really way overbought from these levels, and we are approaching the 618 of the whole down move. That'll come in at 1770. So we're only $14 away on that, and I think that's going to be real interesting to see if this is going to be the place to look at it. But that number comes in at the $1,770 per ounce level. That's the 61% retracement from the high we made back in September when we made the double top and we made the double bottom down in December 29th, and we've been up basically for 6 weeks. And we're coming to a 61% retracement, which is nearly equal to the move from September 26th through November the 7th. So we're getting a little bit of symmetry here, but we should have some resistance up in this area. I've been really wanting to buy gold at some point along here. We did have a pretty good buying opportunity on a short-term basis last week at the 1650 per ounce level that we posted into the room, and it seemed to be that worked really good for a while. So we'll have to wait and see. The other commodity that people ask me about all the time that I actually don't trade is the natural gas market, because it has just made a 21-year low. And what is happening now is we are getting a retest of this bottom that is very interesting. And as a matter of fact, we retested it today. And I'm just going to blow it up as large as I can. And you'll see that this is the pattern that if you wanted to go long natural gas, today's the day to do it. And the reason why is that we've made a 786 retracement of this move for the last 2 weeks. I'm going to bring this in and give you an idea that this is where we are, and you'll have an idea that some of these things actually do work with these patterns. But the natural gas today had a low of 237, and we're already up 10 cents above that right now. But it did make the retest exactly at that same level, which is the same pattern that happened in corn. It's the same pattern that happened in Amazon. So when you see these moves go up and they come down really hard and they stop at either the 618 or the 786, this is where you want to take your chance at buying it, because it's better to buy into corrections because your risk is less. And remember, the risk is the only thing that we can control, folks. We cannot control the profit. We cannot control how much we're going to make on a trade. The only thing we can control in the risk-reward equation is the risk. So focus on the risk. Winners think how much money I can lose. So if you buy natural gas here, you only have to risk below 235, and you will be wrong. That's the basic thing. Now we've got to take a little break before we finish up the show, and I will finish the show with the TBT and also the stock market.
At Tiger Metal Exchange, we pay you more for converting your jewelry to cash.
Let's go to Brian in New Jersey. Hey, Brian, what's going on?
Hey, Tom, just want to let you know I did give you some jewelry. My jeweler offered me about $650. I should get a check in the mail tomorrow for about $1,200.
At Tiger Metal Exchange, it's all about honesty when converting your jewelry to cash.
Okay, let's go to Paul in Florida first. Hey, Paul, what's going on?
I want to commend you on the Tiger Metal Exchange. I just did a deal with you guys the other day.
Oh, good.
And very happy.
Well, I appreciate it. Now, did you sell us jewelry or did you buy coins off us?
I sold you jewelry.
Okay.
Yeah.
Awesome.
See, what we weighted at was less than you guys said, so, you're totally honest.
At Tiger Metal Exchange, we give you the tools to value your gold, and it's absolutely free. Call 866-618-8888 or log on to TigerMetalExchange.com. We've created the easiest, safest, and most honest cash for gold process. Tiger Metal Exchange. It's the only call you need to make.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Would you like to discover the next great tech stock? David White, TFNN's technology guru, has just launched his new newsletter, The Technology Insider. In his newsletter, David will be looking for those shining stars that may turn into the next Apple, Microsoft, or Cisco. David combines his technology background as a software programmer with his market skills as a successful professional trader to give you this unique newsletter. We're on the verge of the next great tech run. With the Technology Insider, you'll be in front of the run-up and not lagging behind. David is developing a long-term investment portfolio. Therefore, we're only offering the Technology Insider as an annual subscription with a remarkable price of only $395. That's right, for a little over $1 a day, you'll receive the fundamental technology wisdom and technical trading skills of the Technology Insider David White. What are you waiting for? Go to the front of TFNN.com, click on the link on the front page, sign up for your 2-week free trial, and become a Technology Insider today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and I'm going to talk a little bit here about the euro. The euro has hit that 618 off of the last ABC several times at this 132 and change level. It's got to get above there, strongly in order to, make another move to the upside. Steve Rhodes talked about that outside day we had in the dollar yesterday, and we both put that into the Tiger TV today, to show you that it didn't follow through to the downside. That tells you that 78.50 level is, very important in the euro at that particular point. Now, with the TBT, we're looking at, this number to come down to the 1680 per share. And so I think it'll be priced a little bit cheaper than whenever Facebook comes out. So we'll be able to see if that's going to be the case. Also, I have a news flash announcement for all of you that have been ragging on me for years. I went into an Apple store yesterday, and I could not believe it. This place was like they were giving $5 bills away, for $3. It was just totally amazing how many people were there and all the stuff and the merchandising. I'm not going to issue a buy on the stock, but they have a lot of business. That's why the $456 a share is probably so amazing to see it, because boy, there were so many little kids in there learning, so it was really it's really a social event. There's no question no question about that. So we'll have to just wait and see what really happens. Now we've got some real serious cycle stuff coming up next Friday, which will be interesting, and we have Combust coming in on the full moon on the 7th, so that's going to be really interesting as we come into the beginning of the week, because Tuesday the 7th is going to be a pretty big trend change day because of the fact that we're having Combust with the Sun conjunct Mercury, and then we also have the full moon at that time. So both of those will be really interesting. We could be making a high either in the stocks or maybe a low at that time. We'll have to wait and see, if that's really going to, to be the case. So that's what we're watching for next week. But the main thing is to keep an eye on these bonds, because I think this is the one that has the potential to, really be interesting and be in it for quite some time, because the whole world thinks that interest rates cannot go down. And usually when that happens, that's the old adage that if everybody's on one side of the ship, they get a good view, but heaven forbid it'll tip over. So, just keep in mind that that's what we're looking at. Now with the stock market, we have not made new highs. I was totally shocked yet. I mean, it's still early in the day, of course, and we could do anything because we're only 10 points away from the high in the S&P. In a matter of a few words out of Bernanke's mouth could set this thing going. But I don't believe we're going to be a breakout type move because there's very little volume happening. The number of new highs to new lows doesn't look nearly that good. In other words, the breadth of the market and the volume is just absolutely horrendous, and it's nearly impossible to have a big bull market in this without a move in volume. Now, I was misinformed yesterday that I thought that the IPO for Facebook was going to be listed today, but now I understand it's going to be several weeks out, which was rather surprising to me. So we'll see if that is, if that's going to have any effect when it does come out. Anyway, thank you all for listening. Have a wonderful weekend. Get ready. Monday the 7th is going to be wild. We got a full moon, and we also have Mercury combust the Sun, so conjunct the Sun, which is combust. Have a nice weekend, folks.